Hey everybody, thanks for joining. I am Crypto Quantamental. Today we're going to have an introduction to Bitcoin and blockchain. Some of the topics we're going to cover. First, how Bitcoin can revolutionize the way we do transactions. Secondly, some basic history on Bitcoin, other versions of electronic cash. Then we're going to dive into blockchain, how it's related to Bitcoin, and how blockchain actually works. Then I'm going to talk about how you can get started today in regard to some cryptocurrencies. And last, some common criticisms when it comes to Bitcoin and other cryptos. So why do we need blockchain and Bitcoin? Honestly, it can revolutionize the way we do things. And it's because it solves many problems that we currently have with the way we do transactions, whether it's through banks, or whether it's real estate transactions or credit cards, or really anything, because Bitcoin and blockchain solves a lot of problems. So what do they solve? Well, it's trustless. There's no reliance on banks or any other third party. It's permissionless, so you can send money across borders without any limits, without having to get permission from anybody or any authority. It's decentralized. It's peer-to-peer, so there's no central authority that has to be a trusted third party like a bank or a government. It's immutable. It cannot be changed. Freedom and control are huge. It's your money, your goods. You should be able to do what you want to do with it. Then it's frankly pretty cheap. It's getting cheaper, but at the end of the day, it is a better deal than credit cards or PayPal, especially if you're trying to send money across borders, which can be quite expensive. Privacy. It's a common misconception that Bitcoin is totally anonymous. It's not, because all wallets or accounts, if you want to call it that, are public, but generally no personal information is available. And there's a limited and known supply of Bitcoin. So there's no, Federal Reserve just printing money nonstop. We always know there will be 21 million Bitcoins. So what's the history of electronic cash? So Bitcoin is not the first attempt. It is an attempt that's standing on the shoulder of many really solid, good attempts. So here's a list of some versions of electronic cash that failed for a variety of reasons. And they all failed until Bitcoin came out on Halloween 2008, with Satoshi Nakamoto publishing a white paper called Bitcoin, a peer-to-peer electronic cash system. Highly recommend you check it out. It's not crazy technical, so the layperson can generally get through it. And even just the abstract is worth a read. I'll talk about some highlights here. So first, it's a purely peer-to-peer version of electronic cash where you can send money or payments without going through a financial institution. That's huge. There's no central authority here. It also solves a problem called double spending, which plagues some other versions of electronic cash, where you could spend money at two places at one time. And the way they solve this problem is through a peer-to-peer network utilizing a blockchain. We'll get into how the blockchain actually works in a little bit. So who is Satoshi? So if you notice, the author on that white paper is Satoshi Nakamoto. The reality is we don't know who that is. We don't know if it's a he, a she. We don't know if it's one person or a group of people. Now, it's a common belief that Satoshi is related to a group of people called the cypherpunks. And this was a group in the 90s and 2000s with a huge dedication to privacy. For example, one member is Julian Assange, the WikiLeaks founder. So that just gives you an idea of their dedication to privacy. So who in this group could potentially be Satoshi, or part of the group that could be Satoshi? One could be Hal Finney. He actually received the first Bitcoin transaction. Unfortunately, he passed away. Another person is Nick Szabo, who's a founder of BitGold, which was another version of electronic cash I mentioned previously. Now, for anyone to prove they're Satoshi, it's actually quite easy. There's wallets or accounts in general terms with billions of dollars in them from when Bitcoin just began. It was able to accumulate Bitcoins. If somebody was able to move the Bitcoin from any of those wallets, they would be essentially proving that they're Satoshi, because only Satoshi has access to those wallets. So far, nobody has moved a single dime from those wallets in years. They've been dormant, which is quite amazing because at the height of Bitcoin in 2017, whoever was Satoshi Nakamoto would have been one of the top 50 richest people in the world, yet they did not touch their Bitcoin in those wallets. There's a few people that the news media has potentially claimed Satoshi, or people that are trying to claim their Satoshi. For example, the gentleman up top, he was outed by a magazine saying he's Satoshi Nakamoto simply because that was his name and he had an engineering background. He denied it, and there's no evidence that he's Satoshi. And there's another gentleman named Craig Wright. He actually says he is Satoshi, claims he is Satoshi, says, talks about patents and all this other stuff. But the reality is he could prove it just by moving some Bitcoins from the old wallets I mentioned before. He has yet to do so. It does have some links to some people that might be Satoshi. I'm talking about like the cypherpunks, but there's no evidence that Craig is Satoshi at this point in time. But he is a big player in the crypto universe at this point. So how does transactions work currently? So in order to understand why Bitcoin, a blockchain, important and might revolutionize the way we do business, we have to truly understand what we do and some of the problems. So right now it's actually pretty straightforward. If I want to do business with a company X, I effectively plug in my credit card and send money to company X. Seems pretty instantaneous, but it's not. It actually has to go through a bank or a credit card processor. Many people take their cuts in terms of fees. It's not instantaneous. We're trusting the bank to do his job. There's no privacy. It's really easy for fraud and theft. I mean, the reality of the situation is, when was the last time somebody ID'd you when you tried to make a credit card purchase? I can't remember. So if somebody got a hold of my credit card, they can rack up costs with no problem. And, you kind of have to involve a bank. Unless you have physical currency and you're dealing with somebody face to face, you have no other option but to deal with the financial institution, which is, a problem generally, because we do want to have a trustless way of doing business. So we can actually solve these problems, but first we have to understand Bitcoin wallets. So a wallet, or if you want to think of it almost as your Bitcoin account, will come with two keys, a public key and a private key. And just think of each key as just a set of numbers. Or you can almost call it your username, but it's a long, very long username. And the key here is your public key you can give out to people, and that's how you receive funds. And your private key is something you never give out to anybody, and that is how you actually access your funds and how you're actually able to send funds. Okay, so let's talk about transactions when it involves Bitcoin and the Bitcoin blockchain. So company X, just like before, what they can do, they can send me their public key. So now I know effectively their account number, but just their public account number. I do not know their private account number, so I can't access their funds. I could just merely send them funds. Then I would access my funds through my private key, and then I can send them Bitcoin to their public address that they sent me. It'll then go on the blockchain, which we'll review in a second. And then at that point, once it's on the blockchain, the merchant, company X, they can actually see their Bitcoin via both their public and private key. But if they want to send anybody that Bitcoin or any of their funds, they have to do it through their private key. Now, this seems complex, but it's not. Many companies are working on making this very seamless, very instantaneous, so the user experience is going to continue to improve. Ultimately, you can almost think of it as, touchless, like you might have, on your phone or credit cards. That's generally how seamless this process will ultimately work, but it's kind of the mechanics behind the scene. So let's jump in and give you a background on blockchain. Now, the reality is I could make a bunch of slides on blockchain, but Goldman Sachs has a great infographic that I'll go through, and it'll give us the 30,000 foot view on how blockchain works. Now, the reality is blockchain is not the same as Bitcoin. Bitcoin utilizes a blockchain, but there's other cryptocurrencies that use blockchains, and some private companies could actually have centralized blockchains for themselves. So this is generally a high overview on how blockchain works, including the Bitcoin blockchain, but it can be applied to others as well. Okay, so first off, a blockchain has to do two things: get the transactions or get the data, and then put them together and keep the history through cryptography. So how does it work in terms of a transaction? Let's just imagine a person wants to buy something from a seller. Now here you have vehicle registration as an example. That's the beauty. So we'll get into various cryptocurrencies later on. But that's the problem a lot of these cryptocurrencies are trying to solve. It's not merely, say, electronic cash. They're trying to make the process of storing and sending stuff like vehicles registrations or real estate transactions smoother. So here's an example of vehicle registration, but if you want to imagine it simply as sending a Bitcoin from Alice to Bill, then you can imagine that too. It doesn't necessarily change the mechanics. Let's just imagine a vehicle registration where a Bitcoin is on the blockchain, then Alice wants to send it to Bill. So, Alice gets the public key from Bill and sends the Bitcoin or the vehicle registration over to Bill. Bill's then able to access it through his private key or his public key. But that transaction is actually sent out to many, many, many people, thousands of different computers out there that store their transaction. Now, they don't know who Alice and Bill are, but they know that the vehicle registration or the Bitcoin changed wallets. Okay, so now we have one transaction, one car being sold, but a block is actually many, many, many different transactions, hundreds potentially. Okay, so you combine all these transactions together in a sequential way, and it ends up forming a block. So just think about like all the transactions that could occur in a 30-minute span. That could all form into one single block. Okay, so now we have a block and we have to link it to the history of all transactions that have occurred in the past. And that is where it gets its term, blockchain, because it is actually a chain of blocks. So this new block has to be added to the end of the existing chain. And the way it actually does it is through a mathematical procedure, in this case called proof of work. There's different algorithms that's used for other chains, which we don't need to get into, but generally there's mechanisms that allow it to connect the most recent block to the chain. Now, the key here is that when the most recent block gets connected to the chain, or when these computers are trying to add a block to the chain, that they do not have the ability to change previous history. It's immutable. It's unable to change. So what's the mechanism to lock these transactions, these histories in place? And the way it works is called a hash. I'm not reading everything on the page, so you can definitely check it out and kind of clear some stuff up. But the main key here is part of a previous block is always embedded in the next block in terms of its cryptographic features, its signature. So this allows the history to continue to go forward. You continue to roll one block ahead. It has a piece of, in terms of a cryptographic signature of all the blocks previous to it. So the key here is if somebody tries to do something, if somebody sends out a bad blockchain, if you want to call it that, from a high level, that the users, all the people getting the transactions, all the people monitoring the blockchain would immediately recognize that that chain is not the correct one, that something happened to it. And when all the chains match up, then people are able to trust what they actually have, and that's the key. It's peer-to-peer verification, if you want to call it that. And here are some other examples on how blockchain, again, this doesn't have to be Bitcoin, it could be other blockchains through other cryptocurrencies and the like. So one here is dealing with counterfeiting. So they're talking about concert tickets here, but this could be talking about coach purses, concert tickets, anything, wine, coffee, making sure, diamonds as another example, making sure it actually came from where they said it came from. So here, if you're trying to buy or sell tickets from a scalper, how do you know that your tickets are real? You can actually utilize a blockchain to do that. I actually love to scalp tickets when I go to events, so this would actually help me. So the way this would work would be the venue or the event would actually put the ticket on the blockchain, and then the original buyer would get a key to access that ticket. And then if that person decides to sell that ticket or tickets, the new buyer would actually get a new key, and so on and so forth. And they can always check to see if they have the original or a real ticket. I jumped ahead a little bit, I apologize, but another feature that could be solved via blockchain is just through more efficient financial transactions. I actually deal in the traditional markets for a living, and one thing there is things are actually quite slow, which is amazing when you think about it's 2019, but it takes a while for financial transactions to actually what they call settle. But if it was on the blockchain, financial transactions could settle almost instantaneously. Another key feature, and this is mainly through another cryptocurrency called Ethereum, it's called a smart contract. And a smart contract, basically you're just writing a specialized code that identifies what to do if some other condition happens. So we'll walk through an example here. So here would be a stockbroker places an order for a stock for a buyer, and he has the keys for both the buyer and the seller because he has to facilitate the transaction. And this would trigger a smart contract that is able to connect to multiple blockchains. Basically, one blockchain dealing with, say, the stock or the asset, and another perhaps for the exchange of funds. But the smart contract's able to make sure both happens relatively simultaneously and trustless. There's no relying on one person to fulfill their end of the deal. It's literally built into the code that they both will fulfill their part of the deal. Another example is digital IDs. There's actually cryptocurrencies that do this currently, and I think it's a fantastic project, especially when you're dealing with countries in emerging markets where identification could be a bigger problem. But here you can embed your identification, your thumbprint, your name, various other features onto the blockchain. And then you'd be easily able to prove who you are no matter where you go in the world. It's quite amazing. Okay, All right, so that's a good part of that presentation. Let's hop back over to my slides. All right, so beyond Bitcoin. So I mentioned, how do you get started with Bitcoin and cryptocurrencies? So Bitcoin is just one of many cryptocurrencies. It's the biggest by far, but there's hundreds of other cryptocurrencies. So you can get started and buy Bitcoin or other cryptocurrencies on exchanges such as Binance, Coinbase, KuCoin, Delta Exchange, and many others. I'll have some sign-up links in the description. It's definitely important to do your own research when it comes to buying Bitcoin or any other cryptocurrencies. They're highly, highly risky with lots of downside, potentially lots of upside too, but lots of downside. So definitely consult with your financial advisor. And some coins such as Ethereum, XRP, Bitcoin, there's, potential use cases. People believe that there are strong potential use cases for those coins. Now, some people, obviously don't believe that, but they all have strong communities and strong proponents for them. There's other coins that are just honestly potentially outright scams. You might have heard the term ICO or initial coin offering. That's where they try to raise money in a way that you generally would in say the stock market, raise capital, but they're doing it by issuing coins. And a lot of main reason why they might do that is to avoid some laws and regulations. Now, some of those ICOs are actually very legitimate projects, building great platforms, with great use cases, but some of those could be outright scams as well. So you really have to do your research. And so how do you store your crypto? So say you go on Coinbase, you deposit some dollars or euros or whatever it might be, and you end up getting some Bitcoin after you make a purchase. So what do you do? What can you do? The key here is if you do not have the private key and your Bitcoin is not there, then it is not your Bitcoin. So you definitely want to store your Bitcoins off an exchange, mainly for security reasons. Of course, if you're a trader and you want to speculate, you kind of need your coins on exchange. However, you definitely have a security lapse potential if you leave it on the exchange. So there's really two main forms of wallets. There's hot wallets and cold wallets. Hot wallets are connected to the internet. They're pretty secure, but not as secure as cold wallets. Cold wallets here actually say they're connected to the internet, but they actually are not. Like I said, I just didn't update that section of the slide, so I apologize. But cold wallets are just not connected to the internet. They're super secure. They're something that you can actually kind of basically hold in your hand. So here's some examples of hot wallets. You could hop on, say, blockchain info, and you can get a Bitcoin hot wallet right there online. For Ethereum wallets, you can go to myetherwallet.com or mycrypto.com and get Ethereum wallets. Cold wallets, now remember, they're not connected to the internet. That's my bad again. I make mistakes, but you can buy those and just go hop on, say, Amazon and buy a Trezor or a Ledger Nano S, and you can get those sent to you, and you can have your Bitcoin very securely stored, off the internet. Lastly, some criticisms. So let me jump back to the Goldman presentation. We could talk beyond the first steps here, which will include some criticisms. So the key here is blockchain and Bitcoin, very, very early stage. If you're watching this in 2019, yeah, we had a big boom in 2017, a bust in 2018, but we've had booms of busts before. But the reality is it's still super, super, super early stage. So this is milestone 1. Companies begin piloting uses of blockchain technology. Milestone 2. Global companies start adopting blockchain. So right now, I would say we're somewhere between milestone 1 and 2, probably closer to 1. So we're certainly not milestone 3 or 4 or 5. So very, very early stage still. So part of the problem here is usability and scale. Blockchains are very secure, they're great, but at this point in time, they still struggle to handle the volume of transactions that exist in everyday life. Visa and MasterCard, they can handle tens of thousands of transactions, a second. So, we need blockchains that can handle that. Now, developers are currently working on increasing that scalability and functionality. We're getting there, but I would say not quite there yet. Another issue here is regulation. We still do not have a Bitcoin ETF in the United States because just going through the regulatory circus with the SEC, CFTC, and others. And frankly, it takes time to get everybody on board, understand the technology, and so forth. So it's going to take years to get full regulatory clarity. But again, baby steps, and every month or two, seems like something's coming out with some country or some regulatory body that adds a little more clarity. And here this basically says, hackers will continue to hack. The beauty is blockchain is incredibly secure. Hacking generally is not a huge problem if you secure your own keys and you don't make any major blunders. So there's ways you can make a wallet, for example, using a passphrase. Well, if you make a super easy passphrase, maybe somebody could guess it. But if you do it based upon recommended procedures, just standard, if you sign up for a wallet, you should be pretty good. All right, so let's back out of here and hop over to my criticisms, and then we can end this presentation. So a bunch of words on here. So I figured I'd bombard you with all the criticism at once. So we can just kind of go down the line here. So some criticisms involve money laundering. That honestly is just BS. The US dollar has a lot more crime, a lot more money laundering by many orders of magnitude. Banks are getting fined billions upon billions for issues that they've had. And the reality is the Bitcoin, blockchain is public. People can see the transactions. They might not necessarily know who is behind them, but ultimately it's if you're doing some nefarious money laundering, Bitcoin is not the place you would want to do it. Thefts, and I mentioned before when the Goldman infographic was going on, it's much lower than you might think. If you follow good procedures with creating your wallet, you should be fairly secure, especially via cold wallet. The key, though, is to keep your cryptocurrency off exchanges. Most of the thefts are going to occur on exchange, as in the exchange itself gets hacked or something happens with the exchange. That's the next part. Just scandals or hacking with the exchanges. That's where most money has been lost. Right now, it's getting better via just stronger exchanges, but there's still issues that happen way too much. Regulation, I mentioned it's improving. ICOs, we talked about that before. Definitely do your research. The volatility of crypto is very high. Definitely talk to your financial advisor about it. You're really investing in something super early stage, kind of like the internet. Now, blockchain and crypto won't be as big as the internet, but think about if you're investing in the internet really, really early, any particular company could go down. And the same thing here. Usability and functionality, that's part of the problem right now. Developers and builders are making huge progress to improve the user experience. The reality is it needs to get as good where grandma can utilize crypto and not have to know any of the crazy stuff that's happening behind the scenes. Plenty of others I couldn't even fit on the page, like Bitcoin uses too much electricity. There's improvements there as well with different consensus algorithms that doesn't use nearly as much electricity. Again, all of these things are improving, and it's part of the growing pains of something that is so emerging like Bitcoin and a blockchain. All right, guys. Well, hopefully you learned something. If we did, subscribe to my channel, Crypto Quantamental. Follow me on Twitter at CryptoQF. Like, comment, etc. I appreciate it, and hopefully you guys will give Bitcoin, blockchain, and cryptocurrency a try.